Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. I'm your host, and in the next few minutes, we'll make today's market headlines actually usable.
And I'm your guest, here to ask the questions your group chat is too scared to type. Today's theme, the Fed is calm, the dollar is not, and big tech is spending on AI like it found an infinite credit card.
Story 1. The Federal Reserve is expected to hold interest rates steady, signaling little urgency to keep cutting. Translation: borrowing costs may stay higher for longer than the rate cut party crowd wanted.
So the Fed is basically saying, we're going to stand here and stare at inflation until it gets uncomfortable, because my credit card APR is already doing stand-up comedy.
Simple version of the finance: think of interest rates like the thermostat for the economy. Cut rates and you warm things up. More borrowing, more spending. Hold rates steady and you're saying, we're not turning the heat up yet.
Except this thermostat controls my mortgage, my car loan, and whether tech stocks decide to be dramatic on a random Tuesday.
Why it matters for normal people. If the Fed pauses, savings yields can stay attractive. Think high-yield savings and money market funds. But it can also mean mortgage rates and other loan rates don't fall as quickly as hoped.
So savers get dessert, borrowers get broccoli, which is fine, unless you're trying to buy a house and the broccoli is also on fire.
Actionable takeaway: if you're carrying variable rate debt, prioritize paying that down, because higher for longer hits variable rates first. If you're sitting on cash for near-term goals, today's yields may still be worth locking in via short-duration options rather than reaching for risk.
I love how the responsible advice is always, don't do anything exciting. Meanwhile, the market is like, what if we price in 6 cuts, then unprice them in a single afternoon?
Story 2. The dollar is sliding. Reports note it's at its weakest level since 2022. Currency moves sound abstract, but they leak into everyday life through prices and investment returns.
When the dollar drops, is that good or bad? Because I keep hearing exports benefit, but my brain hears your vacation just got more expensive.
It's basically like your money's buying power abroad changes. A weaker dollar can make imported goods pricier, and overseas travel cost more in dollar terms. On the flip side, U.S. companies that sell abroad can see foreign revenue translate into more dollars.
So my streaming subscription goes up, my suitcase gets heavier, and multinational earnings calls suddenly sound happier. Great. Love that for us.
Investor angle: if you hold international equities, a weaker dollar can boost your returns when those foreign holdings are converted back to dollars. But it can also be a signal of shifting rate expectations or risk sentiment, so don't treat it as a one-way free lunch.
Action step for normal humans. Check whether your portfolio is accidentally 100% USA, and you didn't mean it. Diversification is not a personality trait. It's math.
Big tech earnings are about to test the AI rally, with investors scrutinizing massive AI spending ahead of results. The key word is capex, capital expenditure, money spent on data centers, chips, and infrastructure.
Capex is the corporate version of, I'm not broke, I'm investing in my future, while your bank app is quietly sweating.
Exactly. And here's what to watch. Companies can justify big spending if they show either strong current cash flow, like ad revenue, or credible future monetization. If guidance says spending stays huge but revenue timing is vague, markets tend to get impatient.
So investors are basically asking, is this a factory that prints money or a very expensive science fair? Because both can involve a lot of blinking lights.
And we got a very concrete example. Meta reportedly struck a deal to pay Corning up to $6 billion for fiber-optic cables for AI data centers. That's the unglamorous plumbing behind AI, moving data fast inside and between facilities.
Nothing says future of intelligence like cables. AI is just vibes on top of extremely expensive cords.
Why it matters for you. First, it affects index investors because mega-cap tech is a huge slice of major benchmarks. Second, it creates picks and shovels opportunities, suppliers of chips, networking, power, cooling, and components if spending stays durable.
But if the spending slows, the whole supply chain gets the "we need to talk" text. So the earnings calls are basically therapy sessions with spreadsheets.
Quick recap for 2026, January 27th. The Fed is signaling patience on cuts. The dollar is at its weakest since 2022, and big tech's AI capex is the big credibility test in earnings, right down to infrastructure deals like Meta and Corning.
Your to-do list. Don't ignore variable rate debt. Sanity check your diversification. And when you hear AI investment, ask the spicy follow-up. Cool. When does it pay?
If this helped, subscribe for the daily briefing and share the episode with someone who thinks capex is a new crypto token. We'll be back tomorrow with more finance news. Clear, structured, and hopefully a little funny.
And if you're watching the Fed this week, remember, the market can be dramatic, but your plan shouldn't be. See you next time.